Hello and welcome to this presentation on retirement planning. What I'd like to chat to you about is just to put you in the picture as to the kind of considerations you need to take into account when putting a retirement plan together. And the objectives of this presentation is to just get you thinking about your retirement and to guide you in achieving a financially independent retirement, the things that you need to think about in achieving that goal. And then if you're looking to discuss the findings of this or your thoughts with any suitably qualified person, then to equip you to ask the right questions when consulting with an advisor, for example. Let's think about retirement. What are the considerations that you have to take into account? At what age would I like to retire? How long should my income last? And this, to a large extent, depends upon family history, genetics, lifestyle, your state of health, and so on. People are living longer. To plan for your retirement money to last you to age 70 or 75 may not be adequate. People are living to 85 and 90, so you need to bear that in mind. What income would you like in today's money? And what rate of income increase would I like in retirement? And the higher the rate of increase, the more capital you're going to need. So that's a big consideration. And the last question, of course, is how much capital will I need? What is financial independence? Not having to continue working, not having to rely on your children. No one really wants to rely on children, but many people have to. Being able to maintain your lifestyle. When you retire, you don't necessarily want to have to sell up everything and go and live in a pokey little place. That's not what you want. That's not why you worked all your life. And unfortunately, the sad truth is less than 6% of South Africans have in fact managed to achieve this goal. It's a scary thought. What are the challenges around planning for retirement? First challenge is inflation, and I'll run through a few slides with you just highlighting the effects of inflation, but that's a big challenge. There's another slide I'll show you on the effects of time and compound interest. Compound interest is, they often refer to it as being the eighth wonder of the world. And in fact it is. The more time you have and the more time you use, the better chance you've got of achieving your financial goals. And then there's discipline, sticking to the plan. Let's look at some facts on inflation. Some of you who are in a similar vintage to myself will remember the good old days, 1972. That was, 38 years ago. Here's a Wimpy menu, and just to show you one of the highlights, a Wimpy and chips, 35 cents. What are we paying today? 35 rand perhaps? That's 100 times more expensive. Let's look at a graph of inflation from 1972 all the way through to 2010. And you can see up until the mid-80s, inflation really wasn't too much of an issue, and then it really started to escalate. And that's 4,000%. That's 10% per year. That's a big number. Imagine if you have to live for 30 years after you retire and you've got to deal with this kind of inflation. That's a massive challenge. To look at the benefits of starting early, this is a really simple graph, but really what it's meant to do is to highlight the effects of compound interest. And if you look at a 25-year-old starting to save for retirement, he would only need to save roughly 11 or 12% of his salary to be able to retire at a decent level. And for every 5 years that he delays the start, if you look at a person who starts saving at the age of 50, you're looking at having to save 52 and 53% of your salary to achieve a similar goal. So you can see what the point I'm making. Let's talk about financial discipline. It's about sticking to your plan. Put a plan together and to the best of your ability try and stick to that plan. If and when you do change jobs and you move out of a retirement fund, whether it be a pension or provident fund, it's very tempting just to take the money and spend it and pay off whatever or indulge yourself. But you need to think before you do that. Often people think, well, I'll take the money and I'll just save a bit more. But the sad truth is it just does not happen. So you need to look at ways of preserving your withdrawal benefits when you retire from or resign from an employer. Avoid the temptation of easy credit. I don't have to say anything more about that, but the world's in crisis because of easy credit, and many households are battling, having to just service interest and credit repayments, debt repayments. So the bottom line is sacrifice now rather than later. And put it in your budget. If you're going to be disciplined, put it in your budget, plan for it, know that that's part of your monthly expenditure, and live with it. Let's look at one or two retirement products, and the more common ones. The obvious one is a pension or provident fund, and this invariably is provided by your employer. I'm not going to go into any detail around these. Each one of the products that I'm going to highlight now is a session all on its own. And then there's preservation funds, and these are funds that you would use to house money when you do resign from an employer and move on to another employer. You're faced with the option: do I take the money, do I pay a little bit of tax, do I spend the money, or do I try and conserve it as part of my retirement plan? And that's where you would use a preservation fund. You can also look at using a retirement annuity, and that would perform a similar function, except that retirement annuities, you can put lump sums in, whether it comes from a withdrawal benefit from a retirement fund, whether it's discretionary money that you just need to top up on your RA and get a bit of tax relief, or you can invest on a monthly basis and get a bit of tax relief on that as well. You've got endowments, and these are also lump sum or monthly investments where the proceeds at the end of the investment term are tax-free. With endowments, there is a contractual saving element to it, so you enter into an endowment for 5 years, and at the end of the 5 years the money comes out tax-free. Very useful for putting together capital, creating capital for retirement, because the income that you can draw then from an endowment, once it's matured and run its 5 years, is tax-free. So that's quite useful, and one can consider using these as part of your retirement. Then there's unit trusts, which are a lot more flexible, and there's a massive range of different unit trusts, going from money market funds, income funds, bond funds, property unit trusts, equity unit trusts, managed funds. There's something like 900 odd different unit trusts. They all have different risk profiles, they all do different things, and the fund managers have different investment mandates, but they are flexible. You can put money in, you can take money out, but they are perhaps a little more transparent than some of the other products around. And in terms of being able to get growth out of the unit trusts, they do tend to be a little bit cheaper than some of the other structures as well. Then there's direct shares on the stock exchange, but there you have to use a stockbroker and instruct him what to buy and sell. Alternatively, he can put together a managed portfolio for you and manage it on your behalf in pretty much the same way, I suppose, as a unit trust, except that portfolio is set up for you in consultation with yourself, and probably owns fewer shares than a unit trust might traditionally own. And then there's offshore investments. The government have recently relaxed exchange control to the extent where every taxpayer can take up to 4 million rand a year offshore. The challenges, though, are trying to decide, what currency do you put it in? What part of the world do you put it in? Do you go in emerging markets? Do you go developed markets? Do you go Europe? Do you go US? Do you go China and India, Pacific Rim? I mean, there is such a wide selection of investments, and you really do need to seek professional advice before deciding on where to invest. If you look at your retirement fund, very simplistically, you've got defined contribution funds, which tend to be probably the most popular of the funds available at the moment, and you've got defined benefit. In the old days, defined benefit funds were more prevalent, and there would be a predefined formula as to how much you would get as a retirement benefit, normally a percentage of your salary times the number of years that you've been a member of the fund, and that would then be an obligation on your employer to ensure that pension is paid. Over the years, defined benefit funds, for various reasons, have become less popular. I think perhaps employers felt that there was a bit too much of an onus on them in terms of taking on that open-ended liability for the pension. So employees were then encouraged to go the defined contribution route, where you fix your contribution level, the employer pays a certain amount in, and you choose an underlying investment portfolio, and hopefully it does the job. There's your contribution. Normally your contribution is fully invested into the retirement funding portion of whatever fund you're on. The company contribution tends to cover the administration charges, the insured benefits such as group life and disability cover. So, for example, where you might be paying 7% of your salary and the company might be paying 7%, after costs and so on, you might find only 3 or 4% of the company contribution is in fact going into retirement funding. So you need to be aware of that as well. And then, of course, there's the retirement age that is determined in the set of rules of your retirement fund. Normally it's 65. Let's look at the different ways that your money can be invested in your retirement fund, whether it's your retirement fund, whether it's unit trusts, whether it's endowments or retirement annuities. Basically, what I'm going to be talking about here, very, very briefly, are the asset classes. So you've got cash, you've got bonds, you've got property, listed property, you've got equities, and you've got offshore investments. And if we look at some of the performance and volatility characteristics of these different asset classes, the dark blue line is the all share index, and you can see that that's been a bit of a roller coaster. The yellow line is the listed property index. That's also been a bit of a roller coaster, but you can see that it's performed quite nicely. The red line is offshore investments, and that went up, then it came down, and it's kind of languishing a little bit. Then you've got the pale blue line, which is bonds. You've got the purple line, which is cash, and then you've got the green line. And you can see that they all have different characteristics. The pale blue line, in fact, is not bonds, it's a diversified portfolio, so apologies for that. But that really is just a mixture of all the asset classes, equal proportions, and you can see how by mixing the asset classes you iron out a lot of the volatility, but you still get a nice, relatively flat upward shape of your performance curve with low volatility. Putting a plan together, what you need to think about. Okay, so how old am I? Could be 30 or 40. The closer you get to 50 and 55, it starts becoming a bit of a challenge in terms of putting a plan together that's going to do the job for you. You've got to determine when you would like to retire. You can retire from 55 onwards. How long does my money need to last? And as I said earlier, that's all about life expectancy, longevity, lifestyle, genetic, family history, and those kind of considerations. How much income will you need? That's pretty simple. As much as possible, I guess, is the answer. What annual increases would I like? And I'm not going to labor the point, but there again, it's all around inflation. And in addition to that, what capital expenditure can I expect to have to incur? Sometimes, well, most times, you've got to consider ongoing capital expenditure for those who can indulge a little bit. There could be regular holidays, visits to children living overseas, replacing motor cars, paying for weddings. All those kind of things have to come into the frame. So where do you start? You get your updated values on all of your investments, set out your assets and liabilities, work out a budget, see where you're spending your money, and with the help of a suitably qualified independent financial advisor, he could probably help you to optimize your disposable income. In other words, reduce on certain things and free up monthly cash flow to be able to put into a retirement plan. One also needs to determine a set of assumptions. The assumptions are things like, what rate of inflation do we assume? What rate of growth do we take into account? We have to determine the rate of growth in line with the risk profile. Right at the moment, there's not too much of an appetite for risk. People are tending to be pretty conservative. But if you think about things practically, if you've got inflation running at, let's say, 6% per annum, right now it's running at a bit less, but you need to err on the conservative side, so plan on a slightly higher rate of inflation. Anything lower than that will impact favorably on your plan. But in order for your money to grow in real terms, then you've got to achieve a rate of growth in excess of the inflation rate. And if there are tax implications involved, for example, if you're investing in cash and there's interest, you've got to take off the tax. So you have to beat inflation. So you have to start mixing asset classes to achieve a decent rate of growth that's going to assist you in achieving your retirement goal. And in order to do this properly, you do need to consult with a suitably qualified advisor. On our website, we do have a calculator that you could use to determine very broadly any retirement shortfalls that you may have. So I would urge you to use that calculator, that tool, and determine exactly where your shortfalls are, and then perhaps give an advisor a ring. What we've done is I've actually prepared a fairly comprehensive exercise using the Foresight Financial Tools retirement tool. It's a bit laborious, but if you're serious about your financial planning and you want to get an insight into exactly what retirement planning is all about and the kind of steps you need to take and exercises you need to go through, then I would urge you to watch this video. It'll open your eyes, and this is on our website. This will give you an insight into practical aspects of setting up a retirement plan. Thanks for taking the time to view this presentation. I hope that I've planted some seeds and that it prompts you to take some positive action in terms of addressing your retirement plan. Should you have any questions, then I would strongly urge you to consult with a suitably qualified and registered IFA, that's Independent Financial Advisor. If you do not have an independent financial advisor and you would like to chat to someone, you're more than welcome to chat to us. Thank you for watching.